Meet Ryan. Ryan has been investing for 18 months, which in Wall Street terms means he still thinks diversification is a conspiracy. His portfolio is up 18% this year. He hit a 12x on a meme coin, and his confidence unbreakable. Ryan doesn't think he's lucky. Ryan thinks he's gifted. Ryan's hobbies include watching market YouTubers at 1.75 times speed, explaining macro trends to people who didn't ask, and calling long-term investors dinosaurs. Ryan is convinced this is his destiny, so naturally, he decides it's time to go pro. Ryan calls his broker, says his net worth is complicated, gets approved for options trading. Fast forward 3 months. Ryan is now fully leveraged on out-of-the-money tech calls. His strategy? Buy high, sell higher. Risk management? Vibes. His partner's question?
Why did our emergency fund just disappear?
3 months later, the Fed hikes rates. Ryan's portfolio is down 64%. His confidence is gone, and his new hobby is Googling, is the market rigged against retail investors? Which brings us to today's question. Why do the dumbest investors win? The answer is something called the Dunning-Kruger effect. It explains why beginners think they're geniuses, why experts doubt themselves, and why Ryan believes market makers personally targeted him. But here's the uncomfortable truth. For the past decade, Ryan wasn't wrong. Since 2009, markets have been on one of the longest bull runs in history. The S&P is up over 700%, which means fundamentals didn't matter, valuations didn't matter, risk management barely mattered. If you bought anything and waited, you probably made money, especially if you bought volatile garbage. Traditional investors think investing is about cash flows, valuations, long-term fundamentals. But the best performing portfolios lately? 600x earnings, no profits, narratives that make no sense. Basically financial fan fiction. Here's the real reason this works. Beta. Beta measures how wild a stock is compared to the market. If a stock has a beta of 1.5, it moves 50% more than the market. Market up 2%, that stock jumps 3%. Market down 2%, it drops 3%. Ryan's portfolio is pure high beta chaos. So in a bull market, Ryan looks like Warren Buffett. His group chat worships him. He starts pricing Rolexes. But when the market turns, gravity shows up, hard. In bull markets, high beta investors look brilliant. In bear markets, they become case studies. Everyone's a genius until the trend reverses. So why do dumb investors win? Not because they're smarter, not because they see the future, because they love volatility, they go all in, and markets rewarded risk for a long time. But every bull market ends, and when it does, beta stops working, narratives collapse, and confidence gets margin called. The same strategy that made you rich is the one that takes it all back. So next time someone brags about a 10x trade, remember, they're not a genius. They're just surfing a wave that hasn't crashed yet. Welcome to WealthFlow.